Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor for ETF.com.
This week, we got a special episode with not one, but two guests. First up, we're talking with Ryan McCormack, Senior Factor and Core Equity Strategist at Invesco, about the history and enormous success of the Invesco QQQ Trust. Then later, Eric Balchunas, Senior ETF Analyst at Bloomberg, is going to join us to dive deeper into QQQ, as well as other ETF-related topics. So you'll definitely want to stick around for that. Jeff, are you ready to get into it?
Yeah, this is going to be a fun one. Let's go.
All right, then. Let's kick things off with Invesco's Ryan McCormack. Ryan, welcome to the show.
Thanks so much. It's great to be here.
Ryan, so almost everyone listening to this podcast has probably heard about QQQ, but not everyone is familiar with how it came to be such a powerhouse. Can you tell us about the history of this ETF?
Yeah, absolutely. So QQQ was launched back in March of 1999 as the Nasdaq 100 tracking stock, and as the original name suggests, it tracks the Nasdaq 100 index, which is comprised of the 100 largest companies listed on the Nasdaq exchange, ex financials. So I feel like I always have to explain that a little bit. The index itself was launched back in January of 1985, and it includes no financials because on that same date, Nasdaq launched the Nasdaq Financials Index, which I think at the time was the one believed to have maybe more commercial viability. But effectively, since then we've seen the Nasdaq 100 blossom into this preeminent large cap growth index. And in 1999, there was a vehicle designed to track the index available for investors. There have been multiple tickers back in 2004. They changed their listing from the American Stock Exchange to the Nasdaq Exchange and changed its ticker from QQQ to QQQQ. So 4 Qs rather than 3. Then again in 2011, it changed its ticker symbol back to QQQ. So just the 3 Qs. And from there, it really enjoyed a pretty significant performance run, both in terms of fund performance, but also in terms of inflows. And we saw in 2017 the fund closed above $50 billion in assets for the first time. It closed above $100 billion in assets for the first time in May of 2020, and in 2021 it closed above $200 billion in assets for the first time. So it's an ETF that is about to celebrate its 25-year-old anniversary, which is something only a handful of funds out there can boast, and it's one that's one of the most widely used and widely known funds out there in the marketplace.
Hey Ryan, even with the changing ticker symbols and various efforts and evolutions over the 25 years. Obviously, QQQ is incredibly popular. It's up to, we have it at over 217 billion in assets right now. Do you have a sense for whether or not this is more popular with retail investors or financial advisors?
I think it's a pretty healthy mix. We see a pretty widespread base of users, whether it be individual investors, whether it be financial advisors, whether it be firm-driven models, or even institutional investors. It's the second most actively traded fund in terms of average daily value out there, right? And with that, and being over 200 billion in assets, I mean, it certainly has appeal across that broad base of investors.
Yeah. I want to talk for a minute about the unique structure, the unit investment trust structure of this, that I'm probably going to get this wrong, but that's why we have you on here to talk to us about it, that it doesn't generate profits for Invesco, right? The money is funneled into marketing and promotion. Is that accurate? And can you break that down for us?
Yeah, so it's broken out in the prospectus, but you're absolutely right in that the structure of the unit trust, which was really just the more popular structure back in the 90s when these strategies were launched, the management fee is driven to Invesco in basis points that are specifically designed for marketing, right, rather than your traditional fee. Um, I think that the benefit for this is we've been able to market QQQ on a pretty wide scale, right? I mean, I challenge you to go on CNBC or any other popular financial television network and go 10 minutes without seeing a commercial for QQQ. Or, back in a few years ago, in 2019, it was announced as the official ETF of the NCAA. We've been able to use this marketing to develop financial education resources like our How Not to Suck at Money program. So all of this success has a great name, right? um, all of the success, though, I think has benefited both Qs, both investors, but also Invesco, and with it, we've tried to try to take advantage of the halo effect, in terms of the name recognition of the fund, as well as just the letter Q. And it's allowed us to sort of build out what we call our innovation suite, which has launched other funds like QQQM that tracks the NASDAQ 100, or QQQJ or QQQS that target the mid cap or small cap arena of the market. So, while Invesco doesn't receive, kind of direct compensation off of that management fee, we've certainly been able to enjoy some benefits of the additional
Mhm.
marketing that's been put forth.
That is interesting that you have all that marketing muscle behind this ETF, which because of this performance, one could argue doesn't even need that kind of promotion. People are going to chase a 25-year-old ETF that has such outperformance, wouldn't you think?
Yeah, I think there's just a lot of knowledge in the marketplace. I think there's a lot of familiarity with the product, and some of the investors that I've spoken to, have held this thing for 10, 15, 20 plus years, right? And
Hmm.
and and whether it's early adopters or folks that are maybe new to the ETF world, I mean, QQQ, we joke, belongs on the Mount Rushmore of ETFs, and again, there's certainly that knowledge base that's inherent with a fund like this.
All right. Well, thank you for that good information, Ryan McCormack of Invesco.
Fantastic. That was great. So next up, we have Eric Balchunas, who is senior ETF analyst at Bloomberg and just an encyclopedia of knowledge when it comes to ETFs. Eric, great to have you on the podcast.
Hey, great to be here.
Eric, so we're entering the final month of 2023 and things seem to be looking up for the stock market. I just checked and SPY is something like 5% below its all-time high. But another popular ETF, the Invesco QQQ Trust, is doing even better. It's only around 3% below its peak level of about 2 years ago. I want to ask you about this ETF because it's just so interesting. A lot of people find the index underlying QQQ to be kind of arbitrary. A stock is listed on the NASDAQ, it can be in the ETF, but if it's not listed on the NASDAQ, it can't be in the ETF. But that kind of arbitrariness hasn't hurt the ETF at all. It's this dominant force that just keeps outperforming and getting bigger. Has that surprised you?
Yeah, well, it doesn't surprise me. Obviously, NASDAQ is an exchange that, again, as far as I can remember, Bill Gates, Steve Jobs, when they listed their companies there, Apple and Microsoft, has just been like the cool place to list your company if you're a juggernaut innovator in America. And I think everybody wanted to follow those guys. And so you've got some of the best companies in America there. And so I always found it to be like kind of the exchange that just attracted that sort of tech genius, sleep 4 hours a night kind of like American spirit. That because the Q's isn't beta per se, it's only half tech even. So it's an interesting anomaly. It's a little more concentrated at 100 names, so obviously its performance will go up or down more than the S&P. But what surprised this isn't that it does well generally, but how well it does. Right, it's up 47% this year. It's just an amazing thing because the Qs was supposed to be like, oh, rates are low, easy money era. Of course, the Qs would do well. But then rates went up. And of course, 2022 was rough, but Qs bounced right back this year. And it's just the relentlessness of the Qs that really fascinates my team. In addition, we all look at value stocks, we look at small cap stocks, we look at international stocks, and they have these like 3-4 month runs, and we're like, okay, maybe a regime is going to change. And it just never happens. The Qs is like, oh, I hope you enjoyed your 3 months. I'm coming back. See ya. And again, it just dominates these other things that are like supposed to have their big long run as the Qs lags, but it just never does.
Hey, Eric, what do you think? You might have already kind of answered part of this, but what do you think makes the Qs so unique and so popular aside from the performance?
I remember writing my book on ETFs, the first one, and I remember explaining in the book something that I dealt with in data, my time in data for years. We went back and forth like 5 times, classifying the Qs as tech sector and then not tech sector. And I think that really defines the Qs, is that I'm an ETF nerd. I was tasked for 12 years in classifying all the ETFs, providing all the correct data. And even I went back and forth. Is it tech or not? And because like if you see a bunch of flows go into the Qs, should that count as tech sector flows or not? I mean, you guys will probably understand how this is in spirit. I think it does, but it's only half tech. There are other companies in there that sell and do other things that are other industries. And that's why it's unique. The S&P to me is like, okay, let's take all the companies, market cap, weight them. Although the S&P has its own nuances, but nothing like the Qs, where it's not really beta to anything. If it's beta to anything, it's beta to, again, people who want to follow the cool kids and list on the NASDAQ.
Eric, what's interesting is that even as great as the Qs have done, recently, if you look over the past 5 years, XLK, the Spider Tech ETF, it's outperformed the triple Qs by 5,000 basis points. And over the past 10 years, it's outperformed by 10,000 basis points with a 520% gain versus 400% for the Qs. That kind of suggests to me that even though the Qs are this kind of tech proxy, it's an imperfect one. Like you said, only 50% or so tech. You would have been much better off in an actual tech ETF over the past 5 or 10 years. What would you tell investors who are looking to increase their allocations to tech through ETFs? Should they look at the Qs or should they look at the dozens of other tech ETFs that are out there?
It's a great question. I mean, it sort of depends what the rest of your portfolio looks like, right? Are you using this as hot sauce? Something where you have the fear of missing out and you want to make sure to add a little? In that case, I think you probably go with the tech ETF because it's going to have more active share. The Qs, a lot of these stocks are in the S&P. They just have smaller weightings. So if you wanted to sell a little S&P and Q up your core, the Q is probably better for that. But I think the reason that people would choose the Qs over XLK is that the returns are still right up there. I mean, it's not like they're lagging XLK by a lot. I mean, they're both juggernauts. But with the Qs, you get some other companies that are not in tech. And these are, again, America's like creme de la creme of innovative companies. Tesla, NVIDIA, is that in the XLK? It might be. Amazon, I think Meta is in communications. So remember, the Netflix, some of these companies are now in the communication sector. The other thing about the sectors in general, I think people have sort of moved off of sectors a little because they were designed in a time before the internet kind of just made a lot of things sort of harder to read. Like, what is Amazon exactly? And I think the Qs sort of capture that thing, that sort of innovative, techy, but not all tech strictly spirit that you really get in the United States. And I think that's why that Qs will get more flows over time than a strict tech ETF that was defined by the GIC sector people. I think over the years, the GIC sectors are just a little stuck in history. And I think that things like the Qs and even thematic ETFs have done a really good job kind of exploiting that. And I don't blame the GIC sector people. They got to divide them at some point. But to me, the Qs, because it does wrap up some of these other companies like a Tesla, because people kind of group Tesla and Apple and Microsoft it together, right? The Super 7 or the FANG names. And so the Qs has all of them. You don't have to like miss out. If you buy XLK, you miss a couple of these. And if one of them goes crazy, again, you don't have that feeling of like, damn it, I should have actually just bought the Qs. So I think people are willing to give up a little of that return in XLK to have that feeling they have a little more diversification of those FANG Super 7 names.
Yeah, I like your hot sauce analogy. I tell everybody that nobody has better analogies than Eric Balchunas. But how long do you think this QQQ rally can last? And can you draw any parallels between this and the dot-com bubble? Is that even possible?
History does rhyme, if not repeat, especially in markets. And how can these valuations stay this high? But we thought higher interest rates would be what changed the regime, but it didn't. And so I don't know. And some people are like, well, you can't buy the Qs now because it's now gone up another 47%. But I'm like, people were saying the Qs are over, 100% ago, 5 years ago. It was supposed to end a long time ago. All these people, the quants, value was supposed to take over. In the 2000s, small cap value was up something like 100%. And the Qs and the S&P were flat to down. And that was a decade. So you're right. If and when it happens that our psyches just change, it's possible you have this long run where it's flipped and the Qs lags for 10 years and stuff like small cap value or international goes up. But, again, it's hard to call that because people have been calling it for a while. There's two other points here about the Qs that I think make me more relaxed about how the rallies are justified is, first, these companies own a ton of names. Like Google is my favorite example because it owns YouTube. YouTube could be a total juggernaut stock on its own. I just got YouTube TV. It's awesome. It's the best TV station I ever had, or TV package. And that's my TV. It's a big part of my life. And YouTube TV is just one part of Google. So these companies, if you actually took a hammer and broke them up, they'd be like 5 or 6 juggernaut stocks on their own. So it's really the Super 7 representing about 40 companies. Now, it's more diverse than people think, and that gives it maybe possibly more legs. The other thing is that when you think about intangible assets, we had Kai Wu on our podcast recently, brand value, IP, human capital, that's how he defines these things that are harder to measure. So if you look by traditional metrics, the Qs should not go up anymore. If you quote price to earnings, price to book, it should be done. We should move on to someplace else. But this intangible value is sort of the dark matter that I think helps justify the Q's levels. And I do think that is a scientific way to somewhat explain some of this. But I got to be honest, if you're a traditionally trained CFA and you grew up in the 80s and 90s and you saw the dot-com bubble burst and you're running a portfolio, it would be very difficult to load up on the Q stocks or the Super 7 more and more. Every bone in your body says, I've got to go to cheaper stocks. But that signal has been there for 7-8 years. And this is
that
why,
was kind of the analogy I was making to the dot-com bubble, that it looks from that, at least for this particular category of stocks, like that. I mean, is it too late to jump on the bandwagon?
Yeah, I mean, it felt like in the dot-com bubble, though, there were a couple stocks that went from 0 to 60 pretty quickly, like
Right.
Pets.com and all that. These companies are basically like, if I look at these companies, I mean, I'm a customer of basically all of them for the most part. They are in my life integral. So that's a little different than, hey, there's this new internet company, let's just jack up the valuation to, the moon. So it doesn't feel as frothy, but perhaps it's because it's grown slower and these companies are so familiar to us. I don't know. It's a great point. But like I said, I think active managers have probably, are borderline ready to go to the psychologist to check themselves in because they're having a major existential crisis here. Because everything they learn just kind of gets thrown away by the Q's relentless drive. On our team, we debate a lot, and we marvel at the Q's just like everybody else.
Yeah, it's incredible. And to your point, Jeff, we did kind of see an implosion in some of the narrower tech ETFs, the cloud computing ETFs and things like that, Carvana, Teladoc, a lot of those holdings in the ARKK absolutely crashed in 2022, and they haven't rebounded like we've seen with the Magnificent Seven. So we kind of did already see that dot-com cycle play out, just not in those, mega cap tech stocks.
There's one other point here that is interesting, which is unlike the dot-com bubble or the ARK stocks. I mean, I haven't looked, but I'm looking at the names: Apple, Microsoft, Amazon, Nvidia, Meta, Broadcom, Alphabet, Tesla, Costco. Especially Apple and Microsoft. The amount of cash they have is enormous, and I think that's something that you don't typically find in sort of high-flying growth stocks, is to have that much cash. And I think that cash provided somewhat of a buffer in the rate rise regime, right? Versus say the ARK stocks. And I think that does make it a little different than the dot-com bubble. These companies are just sitting on piles of cash.
Yep, absolutely. And the valuations just aren't as high. If you look at something like Meta or Alphabet, they're trading at a market multiple, if not less than the market. So that's a little bit different than the dot-com bubble. Eric, since we're on the topic of tech, I want to ask you about a specific part of the tech ecosystem that's gotten a lot of attention this year, and that is AI. There's a number of AI related ETFs on the market today, some of which hold stocks of AI related companies and others which use AI to pick and choose which stocks to hold. Do you see this as a theme that has legs, or is it going to flame out in the same way that we saw with the robotics ETF several years ago?
Generally, I'm more optimistic on the thematic side, because AI is like, if you look at chat, that's like the one that's specifically AI. It's already 61 million. People like to add a little of a theme, like I said, like hot sauce. It fits nicely on cheap beta, and it's just, okay, I'll put 0.5% of my portfolio in this thing because I think AI is a big deal. So I do think there'll be a home for thematic ETFs that are AI focused. Now, on the flip side, smart beta ETFs that use AI, I'm more skeptical of. Most of them tend to be very high cost. Like smart beta has done a good job of getting cheap. Like you can get value, growth, momentum, all these for under 20 basis points now. And I'd argue some of them you could probably stretch and say they use AI, depending on how you define AI. But for these true like AI machine learning type smart beta or active enhanced ETFs, their fees are really high. And they also trade a lot. If you look at the turnover, some of them have like massive turnover. Like it's almost like the computer, it just needs stuff to do. So it trades a lot. So AI backed ETFs that use AI to pick stocks better than a human, they honestly have the same problems as a human stock picker, which is that if you trade a lot and have a high fee, the hurdle you have to clear just to get to zero is just larger and larger. And unless you like destroy the index and create some kind of shiny object moment like an ARK, I just doubt you'll see any buyers. The IBM one has been out for 5 years, the one that uses Watson, and that's only returned half as much as the S&P. Now, it might go on a run. I'm not trashing it, but just the fact. So I just think that until AI either has some kind of taps into some factor and starts to crush it like an ARK and have a shiny object moment, or it starts to compress the fees and become more of a deal. Like, oh, you can get an AI enhanced value fund for 20 basis points. Like I said, I think it's going to succumb to the same physics that apply to every other ETF category, whether it's humans or smart beta, which is, are you cheap or are you shiny? And right now AI is neither. So it's a tough place to be.
Speaking of ARK, Eric, obviously this was all anyone could talk about in 2020 and 2021. Then we saw the crash last year. Where do we stand today with ARK? It still has, several $1 billion in ARKK and some of the other ones like ARKG. Is it just gonna, linger here? Do we need to see positive performance, and then suddenly people are gonna start buying these again? How do you see this playing out?
Yeah, if you look at ARK, they've taken in $200 million this year. Not a lot, but I'd argue just the fact that they stayed afloat the way they did with an 80% drawdown. I mean, that is about as nasty as it gets, is a miracle. And we've used the three V's to describe why ARK has defied all of the high flyers in eras past. Usually, if you have a high flyer like a Janus 20, they have their shiny object moment, then they crash and everybody leaves. But mostly ARK retain their investors, and the three V's are Vanguard. The more that Vanguard takes over the core, the more you have patience with your hot sauce, because it's got a high active share. You already have the serious stocks covered with your Vanguard fund. So you actually want a little wild and crazy from your hot sauce, and they deliver that, and they never wavered from it. So even if it goes down, you're like, well, yeah, of course it's going to go down. These are very highly speculative stocks. And I think, Kathy's ability to communicate the future is very good. And then you've got volume. These things, ARK in particular, trades a ton. So people use them to trade around different things. And the volume helps. More people would look at them now that they trade over $500 million a day. That's very good. And then the virality. I think this goes back to Kathy and the ARK team. They are just very good at getting engagement. I mean, if you couldn't name any PM at Fidelity anymore because their compliance officers don't let them say anything. Yet everybody knows Kathy would, and because she's on TV, she says things that are I don't agree with everything she says, but she says things that get you thinking. She's got a Jeff Gunlock gene, in my opinion, and I think that's important because people like knowing that, yeah, I got a little Kathy to complement my Vanguard, and like I said, they want her to be in the clouds a little bit, 5 years in the future, talking about, flying cars and robots and stuff like that. I think that's why it has staying power. And from Kathy's point of view, there's a line in Steve Martin's great biography called Born Standing Up, where he goes, at first I wasn't famous enough. And then when The Jerk came out, he became too famous. And he goes, right now I'm just right famous. And I feel like ARK is like just right at 13 billion. I think she would even argue that ARK mania was getting too crazy. She was moving the stock prices around with her flows. But 13, 14 billion, I feel like is a proper spot for the kind of stuff she buys. So I'm sure she's pretty content with that kind of middle ground between nobody knowing her and ARK mania.
Good stuff. Good perspectives there, Eric. I just got one more thing for you before we let you go. Would you buy QQQ at these levels?
Okay. So first of all, I cannot give investment advice. Like I'm forbidden to do it. We can't make calls at BI, and I wouldn't want to because I'm one of the first people who subscribes to the Bogleosophy of I don't know the future. I just don't. But I do know that people have been saying that it was overvalued for 8-10 years at this point. Let's just say 4 or 5 to be fair. So I don't know. And these are great companies to own. So if I had a fund that was like, I don't know, dripping money into the Qs, I wouldn't stop it. But again, this is just there's no call either way from me on this. Okay. And it really just breaks down to the fact that the future is unknown. And if anything showed that, it's this year. I don't think anybody called for the Qs to be up this much, or even the market for that matter. And yet here we are. But on the flip side, any rational person probably has the feeling that it just feels a little exhausted. So I think that tension is where everybody is. And I guess the answer is I don't know.
Okay. And for the record, for our audience, that is not investment advice from Eric Balchunas.
Yeah, no, I don't know the future. I don't know what's going to go up or down. I mean, that's so, and I truly mean that. I'm not just saying that because I can say it. That's like I said, I'm an ETF analyst, I don't do macro.
All right, good stuff. Thank you very much, Eric. Thanks for being here and helping us out.
You got it. Thanks for having me.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.